Hello, I'm Dan Coatsworth, editor of Shares Magazine. Today, talking to John Pattullo from Henderson Diversified Income. John, hi. Most investors should be familiar with buying equities to obtain an income stream, but your fund's slightly different because you invest in corporate bonds and secured loans. Could you talk to me the difference in terms of risk profile for these products?
Yeah, it's a good question. Generally lower risk. I think one way to look at an equity is essentially a bond which has a variable coupon, otherwise known as the interest or the dividend in this example, and an infinite maturity date, because that's kind of what a share is. Shares can pay dividends at the discretion of the company and they never redeem. So if you back that out into what a bond is something which does have a fixed maturity date, so you get your money back, and they have to pay the interest or the coupon to service the debt. And for that reason, bonds are safer than equities. In addition, in bankruptcy, bonds obviously rank senior to equity. Equities are junior parts of the capital structure, which I think a lot of people forget. I think a lot of people think equities are senior to bonds, and it's obviously the opposite is true.
So about 2/3 of your assets are in corporate bonds. There's some familiar names like Verizon and Aviva. I'm right in saying that these products are not actually available to the general public, but actually going through your fund, they can get exposure?
Yeah, a number of things. I mean, generally bonds can be bought by the general public, but it's a bit fiddly. The bond market is essentially a professional investors market. Some bonds you can trade in lots of 1,000 on share platforms. Other bonds, predominantly financials, but not all, you need 100,000 at least to invest in. So that's obviously prohibitive. Correctly so in some financial bonds, so CoCo bonds, capital contingent convertible bonds, are loss absorbing, which means in a bankruptcy you could get wiped out by the regulator. And for that reason, they're not allowed to be distributed directly to the public. And I think that makes a lot of sense. Now, this company invests in loans, investment grade bonds and high yield bonds. Loans are very hard to buy as an individual. You need to be a professional investor. They generally trade in lot size of 1 million. So you got to be pretty wealthy to buy one, obviously. And the idea of launching this company, Henderson Diversified Income, is that we can asset allocate between loans, investment grade and high yield bonds, and give people access to a vehicle which invests in loans, which obviously the public couldn't. And there's a final addition there in our OICs, so in our unit trust range, you can only put 10% of loans in the OICs. So this is why we launched this investment vehicle, to give people access to our asset allocation, but it includes secured loans, which are an unusual asset class, quite interesting, senior and secured. So in that capital stack example I spoke about, at the very top is a senior secured first lien loan. Underneath that is a second lien unsecured high yield bond. Underneath that again is your equity we were talking about.
Do you undertake the same amount of due diligence when looking at corporate bonds as a fund manager might do when looking at individual company equities?
Yeah, predominantly it's very similar, but I think it's important that we're just creditors, we're just bondholders, we don't get any say in the management, we can't vote the board out, we don't get any voting rights, unlike the shareholders. And I think it's important to remember that a company is run for the shareholders. So the bondholders are frankly just cheap finance. And with that in mind, you have to make sure that the business has a sensible strategy, so corporate strategy. Does it make sense? Should it exist? Do people want to buy the products and all that sort of stuff? And then if a business strategy makes sense, you then have to look at the financial strategy, i.e. the balance sheet. Has it got a sensible amount of debt on the balance sheet? When does it mature? What are the risks? And so on. And really only if those two caveats are met, would we look to potentially invest in the bonds of the company.
So you can earn an extra income by taking on some of the default risk. Can you explain why you do this, please?
Yeah, I mean, I remember if you were buying the shares, you would be taking default risk as well, because if a company was to default, the senior secured loan holders would get paid first. Anything left would go to the junior unsecured bond holders, and then thirdly, the monies would come back to the equity. But obviously when a business goes bust, normally the equity is wiped out. So everyone is taking default risk, or I'd rather phrase it, the probability of default. because obviously you're never going to invest expecting something to default. But the point about that is it's compensation for default. So the extra yield we get is for the probability of that business defaulting within the spread. So let's say like a Tesco 30-year bond yields 5% for the sake of argument. Roughly maybe 3.5 or 4% of that is Tesco risk, and that sits above the underlying government bond risk. So that first bit is called the corporate bond spread, the compensation for a number of things. One is default, one is liquidity, because bonds aren't as liquid as shares. And one is a kind of general systemic risk in the world. I need extra yield to buy Tesco's compared to government bonds. So with that in mind, we have to assess whether that extra 4% of risk is fair compensation for the probability of Tesco defaulting. And we have to make some consideration for the size of the business, the size of the bonds, liquidity in the bonds, can we trade in and out and so on. And are we being fairly compensated for that risk? And that's the way we look at it. And obviously that stacks up against Morrison bonds and Marks and Spencer's bonds and all other bonds within that universe, maybe the investment grade universe. You've got to look against in sterling, for example, and then you've got to look against the high yield universe and the loan universe, and actually against the equity, what the equity might yield as well. So it's a judgmental view on compensation for the risk you take buying that bond compared to all the other bonds in the market.
Do you say there's any red flags that you try and monitor that would make you want to sell a bond that's already in your portfolio?
Yeah, it's a really good question. And a lot of the businesses we invest in tend to have a quoted equity. Not all, but a lot. Some also have a credit derivative. So that's a derivative which matches the value of the corporate bond in many ways. So that's another liquidity instrument assessing the value of risk in the business. Now, red flags are useful things. Obviously, we're not going to invest in a business which continually destroys value. So there are some structural problems in many industries, such as retailing, for example, which generally, fashion retailing is a very tough business with the internet and so on. So generally, we wouldn't invest in a business which is in structural decline. Now, we're bond managers as well, so it's unlikely we would invest in a sunrise business, something like Netflix. Great equity story, but it's still quite early on in its build-out stage. It needs a lot of financing. And I don't think you're currently getting rewarded properly for the risk of Netflix, even though it has a massive equity valuation, because it's still not turned cash flow positive. Now, in the middle there, we try and invest in fairly mature, seasoned, sensible businesses, which shouldn't disappoint. Businesses do disappoint, of course, and obviously what we'd tend to look for is maybe a shock profit warning, but even a profit warning from a competitor company in the same industry, which might not have bonds, is a classic red flag. When management lie to you, or are inconsistent with you, or tell you one thing and the opposite happens, obviously you're going to lose some credibility. Or if a competitor says something which doesn't stack up with what that management. So it's a consistency of message. If it doesn't stack up, obviously we'll be quite wary. I think thirdly, we see some businesses who acquire to buy growth. So I remember one business, it could never grow organically. It kept on buying businesses and consolidating the market, but then it never seemed to grow. So there was something kind of sniffy going on. It's like, well, hang on, you keep buying things, but you never grow. So that's kind of quite common as well. And thirdly, obviously, not so much red flags, but legislation changes, regulations change. There's always some political event or something which you'd just be wary of, so that when the news hits, you'd hope it's already in the price, and it's not in the price. You shouldn't really be in the bond if you had an idea it was coming along. So a number of things, but it really doesn't stack up, doesn't make sense. Is there a consistent message? Is management got some continuity of approach and leadership and delivering? And that obviously that's not true of a fair number of businesses in the world. I mean, finally, on the structural theme, and we've spoken a bit quite often in Henderson about, there's lots of threats in the world, not just regulatory and political, but digitalization is a massive opportunity and threat to a huge number of businesses. And that's something we try and keep an eye on, robotics and, something like the effect that Uber is having on the London taxi trade or Airbnb is having on the hotel trade. So I wouldn't say they're red flags, but they're very structural things going on in the background, which is just going to make life tougher and tougher for businesses. And so often everything's fine, and then a new technology comes along, and then you might have a downturn in the economy, and that's when it really hits. And that's when the business generally can fall off a cliff. So constantly have to be mindful of threats to the businesses we invest in.
Finally, are you concerned about the outlook for the corporate bond market at the moment?
Yes, that's a good question. Yeah, I mean, there's always stuff to worry about in the bond world. There's a number of themes that we could speak about, and the most recent, obviously, is the Trump election, and the equity market has sort of leapt on a reflationary trade, which has meant that the US government bonds, treasury markets have sold off quite a lot as the market puts in premium for Trump, raises inflation expectations as well on allegedly a better growth and more inflation backdrop. Now, bond managers don't like inflation, and we don't like rising interest rates, so understandably the bond market is backed up quite a lot. And the skill is how much has it sold off relative to where it should. And our sense is there's been quite a sell-off in treasuries, so one shouldn't get too bearish going into next year, because the 10-year, for example, was yielding 1.34, well, 1.4 earlier in the year, and now it's like 2.3%. So it has backed off a lot for the so-called reflationary trade on Trump. Who knows whether that will come? We're a little bit skeptical. What we do know is the yields now are a lot more attractive to investors than they were in the summer or the spring. And an additional one is obviously political risk in Europe, because Trump, I think, will suck growth from the rest of the world. And he may make America great again, but probably at the expense of the rest of the world. That will mean lower growth for Europe and Asia, and that will mean greater political problems for Europe. And obviously Brexit and Trump, I know a lot of people are understandably worried about rising populist backlashes in Europe, and that's something we're monitoring very closely. However, these things can throw up opportunities as well. We don't wish for volatility, but you need a little bit of volatility, because it means bonds can get shaken out, and sometimes it can throw up interesting valuations for our clients.
Thanks very much, John, and thank you for watching.